Welcome to the deep dive. Ever wondered what makes a company like Cameco, ticker symbol CCJ, so central to the global conversation about clean energy and nuclear power? Today, we are grabbing our magnifying glass and diving deep. We've got a couple of key sources, a recent research report from Compascope and Cameco's latest first quarter 2025 earnings call transcript.
Yeah, and our mission here is really to cut through the noise. We want to unpack Cameco's business, get a feel for the competitive landscape, see what their growth strategy looks like, size up the risks to actually pulling that off, get the key takeaways from their latest results, and maybe most importantly, pinpoint the critical factors you should be watching if you're interested in this company or, well, the whole nuclear sector.
All right, let's jump right in then. So Cameco is described as a leading global provider of uranium, right, and services for nuclear power. Most people probably think uranium mining when they hear the name, but their business seems much broader than that.
That's absolutely key. Look at the Compascope report. It really breaks down their business lines, and yeah, it's way more than just digging rock. So first, you've got the core, the arranging segment. This is the mining and production part, and crucially, it includes what they call Tier 1 mines.
Tier 1. What makes them Tier 1?
Basically super high-grade ore and long operational lives. Think McArthur River Key Lake, Cigar Lake in Canada. World-class stuff. Means lower cost per pound. They also have a 40% stake in the JV Inkai operation over in Kazakhstan. Adds a lot of production volume. And beyond just mining, this segment covers exploration too, looking for the next big deposits like Millennium, other spots in the Athabasca Basin. And then, of course, they sell uranium, mostly through long-term contracts with utilities.
Okay, so that's getting the uranium out and selling it. What happens next in the chain?
Right, that leads to the fuel services segment. This is where they take that mined uranium, the yellow cake, and process it further. They've got a facility in Port Hope, Canada, does refining and conversion, turns the yellow cake into UF6 uranium hexafluoride.
UF6?
Yeah.
That's the stuff needed for enrichment, right?
Exactly. It's the gas form you need for enrichment, a crucial step before it becomes fuel. They also refine UO2, uranium dioxide, and make fuel bundles specifically for CANDU reactors.
Ah, the Canadian reactor type, mostly.
Yeah. Used mainly in Canada and a few other places. And the report also flags potential future stuff here, like the Global Laser Enrichment GLE project.
Okay, so UF6 for enrichment, UO2 fuel for CANDU.
Yeah.
Got it. And then there's the Westinghouse investment. That was a huge deal, wasn't it?
It really was. Their big investment in Westinghouse Electric Company fundamentally broadened their whole exposure across the nuclear fuel cycle. Through Westinghouse, they're now involved in actual reactor technology, including the cutting-edge AP1000 reactor designs, plus nuclear fuel fabrication and servicing for all sorts of reactor types, not just CANDU. And reactor lifecycle services, building new plants, maintenance, life extensions, the works. Oh, and technology licensing, too.
Wow, okay. So they've gone from the mine to the mill, conversion, now into the fuel itself, the reactors, servicing. Where does that GLE laser thing fit in again?
Compascope kind of groups GLE under diversified energy solutions, more future-focused stuff. GLE is about developing tech to re-enrich depleted uranium.
So taking what's essentially waste.
And potentially turning it back into usable fuel. Yeah. Could add new supply streams down the line for both uranium and maybe conversion services too.
All right, so looking at the whole picture then, Compascope basically groups it into primary uranium supply, the mining part, fuel services, refining, conversion, CANDU fuel, reactor and nuclear fuel cycle services, that's the big Westinghouse piece, and then these future innovative things like GLE. It's a much more integrated play than just being a miner.
Exactly. It lets them capture value at multiple points along the way to actually powering a nuclear reactor.
Okay, so with that broader picture, how does Cameco actually stack up against the competition? Who are they really going head-to-head with, and what gives them an edge, or maybe where are they vulnerable?
Good question. The Compascope report digs into their competitive advantages, and a few really stand out. Like we said, those Tier 1 assets are huge. McArthur River, Cigar Lake, high grade, low cost, hard to match. Another massive one, especially right now, is geopolitical stability. Most of their production is in Canada, politically stable.
Yeah, I can see utilities liking that a lot these days.
Absolutely. For Western utilities wanting reliable, non-Russian supply, very attractive. Then, the integrated fuel cycle bit through Westinghouse is a big differentiator. It diversifies revenue away from just uranium prices, gives them exposure to new reactor builds, servicing it's a broader base.
Right.
Their contracting strategy is also seen as a strength. Focusing on long-term deals gives them revenue stability, protects against short-term price drops, but still lets them benefit if the market moves up. And finally, the report highlights their solid financial strength. Good balance sheet gives them stability and firepower for investment.
Okay, those are the strong points. What about the challenges? Where are they maybe less strong compared to others?
The report points to a few things. One is the limited flexibility or risks in Kazakhstan with that JV Inkai operation. Things like sulfuric acid shortages for production, potential tax changes, tricky logistics. It adds uncertainty. There's also production reliability. I mean, they have great mines, but keeping complex operations like the Key Lake mill running smoothly, dealing with aging infrastructure sometimes, it needs constant focus and investment.
Always a challenge in mining.
Definitely. They also face market dependencies. They rely on when utilities decide to sign those big long-term contracts, and that can be kind of lumpy, not a steady stream sometimes. And like we heard on the earnings call, there's that recent noise around geopolitical tariff risk, potential U.S. tariffs on Canadian energy, though uranium has exemptions for now under CUSMA.
Okay, so how does this play out when you actually compare them, say, against Kazatomprom, the biggest producer?
Right. Compascope lays out these comparisons. Versus Kazatomprom, Cameco's big advantage is that geographic stability and discipline contracting from a Western base. Kazatomprom might have lower operating costs using their ISR method, but they carry much higher geopolitical risk, being concentrated in Kazakhstan, plus those operational risks like acid supply and logistics we talked about.
So it's kind of cost leadership versus stability and reliability.
That's a good way to put it. Versus energy fuels, Cameco just operates on a totally different scale. Better margins, global reach. Energy fuels is much smaller, focused on the U.S., and trying to diversify into rare earths, which, brings its own set of risks.
Right. Different play entirely.
Yeah. Versus Orano, the big French nuclear company, Cameco has more diverse customers geographically and those super efficient Tier 1 mines. Orano's very vertically integrated, but they face challenges with aging infrastructure and are really dependent on European policy shifts.
Okay. And what about someone like NexGen with that big Arrow project everyone talks about?
Versus NexGen Energy. Well, Cameco is already producing, generating revenue, financially strong. NexGen is still pre-revenue. They face massive hurdles, development risk, huge capital needs to actually build that mine. Although, to be fair, Arrow is a fantastic deposit for the future.
So pulling it all together, what's Compascope's final take on Cameco's competitive position?
The report concludes they have a really defensible position as a market leader. That mix of Tier 1 assets, the integrated presence now with Westinghouse, and the stability factor. It gives them a clear edge over peers who might face higher risks, more complexity, or are still just trying to get projects built.
Okay, so they're sitting pretty well competitively. Given that, what's our actual game plan for growth? Where do they go from here?
The Compascope report outlines their growth strategy, and it really builds on those strengths we just discussed. A key part is optimizing and potentially expanding Tier 1 production. That means getting the most out of McArthur River and Cigar Lake. And importantly, they have the flexibility to ramp up production towards their licensed capacities. Like McArthur could potentially hit 25 million pounds a year.
Wow.
Yeah, but, and this is crucial, only if they secure the long-term contracts to support it. They're not just going to flood the market hoping for the best.
That makes sense, ties back to that contracting discipline.
Exactly. The Westinghouse investment is also absolutely central to growth. The report actually projects it could drive a 6-10% adjusted EBITDA CAGR.
Compound annual growth rate of operating profit.
Right. Over the next 5 years, just from that Westinghouse piece, growth comes from getting involved in new reactor builds like the AP1000, servicing the huge existing fleet fuel fabrication.
So Westinghouse isn't just about spreading risk, it's a serious growth engine for them.
Absolutely. Longer term, they're still pursuing high-grade exploration to find the next generation of top-tier mines. And underpinning it all is that strategic contracting. They're actively building their long-term contract book. The report mentioned numbers like 220 million pounds of uranium, 85 million KGU of fuel services already locked in. That secures future revenue and gives them exposure if prices move higher.
And the GLE thing.
Right. Pursuing GLE is about adding potential future supply options, especially as the conversion market looks tight.
How realistic does the report think this strategy is? Can they actually achieve it?
Yeah, the analysis suggests the strategy has really strong revenue potential, particularly from optimizing those Tier 1 mines and leveraging Westinghouse, especially with new AP1000 orders potentially coming from places like Poland and Bulgaria. The achievability is rated high. Why? Because they're sticking to what they know, running world-class mines in stable places and expanding via Westinghouse where they have expertise and financial muscle. The risks mention contracting delays. Maybe tariffs are seen as pretty moderate compared to the kind of make-or-break risks some competitors face with their growth plans.
So overall, the report suggests Cameco's strategy is maybe more achievable, potentially higher reward, and lower risk than many peers.
That's the main takeaway, yeah. It's seen as a more disciplined, kind of de-risked path to growing across the whole fuel cycle.
Okay, understanding the plan is one thing, but, execution is everything. Can they actually pull it off? What are the real-world risks Cameco faces in making this happen?
Right. The Compass Scope report looks closely at that execution risk.
Mm-hmm.
They rate the risk around jurisdictional stability as low. I mean, most production is in Canada. That's a huge de-risker compared to operating elsewhere.
Big advantage there.
Huge. Operational reliability is seen as moderate risk. Running complex mines and mills like Key Lake, there are always challenges. It needs constant investment to avoid bottlenecks or unexpected shutdowns.
So not zero risk, but something they actively manage.
Exactly. Geopolitical dependencies are also pegged as moderate risk, and that really points to the JV Inkai in Kazakhstan. Issues there, acid supply, tax changes, getting product out of Central Asia can impact things. But because it's only part of their overall supply picture, the risk is sort of buffered by their Canadian assets and diversification.
Diversification helps cushion that blow.
Precisely. Contracting strategy dependence is seen as only a minor risk. Okay, maybe delays in utilities, signing those big contracts could affect the timing of growth, but the strategy itself is sound. It's more about pacing. And finally, supply chain and regulatory risks for specific projects, like upgrading the Key Lake mill or developing GLE down the road. Those are seen as manageable. They've got the expertise, and they're working in places like Canada and the U.S. with generally cooperative regulators.
So how does that risk profile look when you put it side by side with competitors?
This is where Cameco looks quite favorable in the report's view. Kazatomprom. Significantly higher risk, single country concentration, those ongoing operational and logistical headaches, government policy shifts, energy fuels, higher risk too. Limited scale, questions about cost competitiveness versus the giants, and that untested move into rare earths.
Right.
Urano, moderate to high risk. They juggle operational complexity across their whole integrated system. They're dependent on potentially shifting European rules and dealing with aging facilities.
Complex picture for them.
Very. And NexGen Energy, highest risk category, pre-revenue, massive development hurdles, needs huge amounts of capital. It's just a different ballgame.
Wow. So the key takeaway on risk is that Cameco's execution risk is just fundamentally lower than most of its peers, according to the analysis.
That's what the report concludes, yeah. Stable assets, proven track record, diverse base, financial strength, disciplined strategy. It all adds up to a more predictable path.
Okay, let's pivot now. Let's look at the latest report card. What did Cameco actually talk about on their Q1 2025 earnings call? What were the recent updates and market trends they highlighted?
Well, on the call, management sounded pretty positive about the overall momentum for nuclear energy. They kept hitting the point that nations are reaffirming commitments, extending reactor lives, pushing new builds. They specifically mentioned China's continued rapid pace, approving lots of reactors, and that big AP1000 project in Poland, which is a direct opportunity for Westinghouse.
Right. I noticed the CEO mentioned geopolitical and trade policy as sort of distractions early on. What was the update there?
Yeah, they addressed that potential U.S. 10% tariff on Canadian energy products that popped up in January. But crucially, they clarified that natural uranium, UF6, and enriched uranium compliant with the CUSMA trade deal.
That's the new NAFTA.
Right. That stuff is currently exempt. They also mentioned the April 2025 Section 232 investigation the U.S. started, looking into reliance on foreign critical minerals, including uranium. Cameco basically said, look, we're monitoring this closely. We've been through these before, and we're taking steps adjusting contract language, positioning inventory strategically to mitigate risks. If things change, they seem proactive about it.
Okay, good context.
Yeah.
So how did the actual Q1 numbers look?
Pretty strong, actually. Revenue up 24% year over year. Gross profit jumped 44%. Adjusted net earnings were up 52%. And adjusted EBITDA was up 5%. And one of the really interesting things they pointed out was their average realized uranium price in Q1. It actually increased compared to Q1 last year.
Increased, even though the spot price fell quite a bit in that period.
Exactly. The spot price was down like 30%, but their realized price went up. It really underscores the value of that long-term contracting strategy. It shields them from spot volatility and locks in better prices.
That's a powerful point.
Yeah.
How did the specific segments do? Uranium.
In the uranium segment, their share of Q1 production was a bit higher than last year. Their annual production guidance for McArthur Lake and Cigar Lake, 18 million pounds on a 100% basis, is unchanged. They're still balancing, producing themselves versus managing inventory versus buying on the market.
What about Inkai in Kazakhstan? Any news there?
Yeah, production there was actually suspended for most of January. So the 2025 target for the JV is now 8.3 million pounds, 100% basis. Cameco's share they expect to purchase is 3.7 million pounds. They don't expect deliveries from Inkai until the second half of the year, and they flagged those ongoing risks, acid supply, logistics. But on the plus side, they did get an $87 million cash dividend net of taxes from Inkai in April based on 2024's strong performance.
Okay. How about fuel services?
Fuel services saw production up 5% in Q1. Annual guidance, there's still 14 million KGU. They highlighted really strong realized pricing in Q1 for fuel services, said it was due to new contracts rolling on at better prices, and the timing of one specific contract helped too. They expect that strong performance to continue as more higher-priced contracts kick in.
And the big one, Westinghouse. How's that investment tracking?
Right. Westinghouse reported a net loss in Q1. Management explained that's partly normal quarterly swings, plus the big amortization charges from the acquisition accounting. They still expect an annual net loss for Westinghouse between $20 and $70 million for the full year on that net income line. But they really focus on adjusted EBITDA as the better measure of operational cash flow, and that improved 19% versus Q1 last year.
Okay, so operationally doing better.
Yeah. They expect a weaker first half, stronger Q4 for EBITDA. The full-year target for Cameco's share of Westinghouse adjusted EBITDA is still a pretty solid $355 to $405 million. They also got their first cash distribution from Westinghouse in February, $49 million for Cameco's share. They sounded pleased with how it's performing and the potential there.
They also mentioned settling some IP dispute with Korean companies. That sounded potentially significant.
It did. Grant Isaac, the CEO, talked about it. Basically, this settlement resolves a long-running intellectual property issue. The key thing, it shifts the relationship from potential competition to collaboration. It means Westinghouse can now participate more effectively in Korean-led new reactor projects, especially those using fixed-price models where maybe Westinghouse wasn't as competitive before. It expands their market.
So more opportunities for Westinghouse globally.
Potentially, yeah. Details are confidential, but they sounded quite positive. The timing obviously depends on when projects get the final investment decisions, FIDs, and award the big construction contracts, the EPC contracts. He mentioned Korea's bidding in places like Czechia, where things are moving along.
Gotcha. What other big picture market stuff did they talk about on the call?
They really hammered home their core market view. Demand for nuclear fuel is strong, durable, driven by clean energy needs, climate change, energy security, all that. But, and this was a major theme, they see the risks to supply as being much greater than the risks to demand right now. Utilities just aren't contracting long-term fast enough to cover future needs.
They gave some big numbers on that, didn't they?
Huge numbers. Like 70% of the world's uranium needs through 2045. About 3.2 billion pounds are currently uncovered by contracts. And for 1.3 billion pounds of that, they don't even know where the primary production will come from yet. Their point is, you need those long-term contracts to give suppliers the confidence to invest the billions needed to bring on new supply.
And utilities have been focused elsewhere recently.
Yeah, they noted utilities have been scrambling to lock down downstream services conversion, enrichment because of all the uncertainty around Russia, tariffs, etc. But Cameco believes the focus has to shift back upstream to securing the actual uranium soon.
So that tension is building. Huge future demand. But contracts aren't there yet to trigger the supply response.
That's the core message. They also mention ongoing transportation and logistics challenges, geopolitical impacts on routes, things like the Panama Canal, just setting up new, reliable shipping adds to supply risk. Cameco feels they manage it well, but it's an industry issue.
Anything else specific? China, India.
Touched on China's rapid build-out, like 10 reactors a year recently, and the good relationship with Westinghouse Camo there. It benefits the U.S. business and shows projects can be built fast. Mentioned India too, ambitious plans, good relations, potential future opportunities, but no firm timelines on specific projects like AP1000s yet.
And what about all the uranium held by those physical funds? It's still an overhang.
Grant Isaac addressed that. Said, yeah, it comes up. Some people hope it hits the market. But basically, they see it as increasingly irrelevant. The sheer scale of the projected long-term supply gap dwarfs what those funds hold. They worry less about it now.
Okay, that's a ton of useful detail from the earnings call. Really paints a picture of solid execution in a complex but fundamentally strong market. So let's bring it all home. Based on both the Compass Scope report and these recent updates, what are the absolute critical factors someone should be watching if they're following Cameco?
Yeah, Compass Scope actually ranked these, and they line up really well with the earnings call themes. The ones they flagged as high importance are, first, long-term uranium contracting activity. This is number one. Are utilities signing deals? How fast? At what prices? It drives everything. Second, global nuclear energy policy and demand growth. Government support, reactor life extensions, new builds, the fundamental demand picture. Third, uranium and nuclear fuel pricing dynamics. Spot price, yes, but also term prices, conversion, enrichment costs, what's happening with secondary supply, all key to their margins. And fourth, Westinghouse performance and expansion. How much cash flow is it generating? Is it winning new deals for AP1000s, maybe SMRs down the line? That's the diversification and growth engine.
Okay, those are the really big levers. What about the next tier down, moderate to high importance?
Right, in that group they put operational performance of key Tier 1 assets. Just keeping McArthur, Cigar Lake, Key Lake running smoothly and efficiently. That's core production reliability. And Kazakhstan JV Inkai, risks and performance. Managing those acid, tax, logistics issues, it's a big chunk of supply, so its performance matters.
Makes sense. And the ones rated moderate importance.
Yeah, there's a handful there. Still important, but maybe less volatile day to day. Things like those geopolitical risks and trade policies, tariffs, sanctions, broader industry supply dynamics, what are competitors doing, the actual pace of SMR and advanced reactor adoption, cost inflation hitting their operations, capacity in the conversion and enrichment parts of the industry, and just general global macroeconomic conditions.
So it's really a mix of company specifics, market forces, and these bigger policy and geopolitical factors that create the landscape for Cameco. Those are the main areas of uncertainty to track.
Exactly. They shape both the opportunities and the potential challenges ahead.
Well, we have certainly covered a huge amount of ground in this deep dive. We went from Cameco's pretty diverse business model and its competitive strengths, those Tier 1 assets, the stability through their growth strategy and, relatively lower execution risk compared to peers. Then we dug into the specifics of their strong Q1 results and the key market insights from their latest call, and finished up mapping out those critical factors you should really keep an eye on.
Yeah, it's clear Cameco isn't just passively benefiting from renewed interest in nuclear. They seem to be actively using their specific strengths and strategy to capture value right across the fuel cycle.
So to leave you with a final thought to chew on, consider this. Both sources really highlight this massive and growing gap. Billions of pounds of future uranium demand are currently uncovered by long-term contracts. Yet despite all the talk about nuclear's comeback, utilities aren't signing those contracts fast enough to really incentivize the huge investments needed to guarantee that future supply. So if utilities absolutely need fuel security for decades, and suppliers like Cameco absolutely need contract certainty to commit billions in capital, doesn't the pressure from this widening supply gap have to, break somewhere eventually? It feels like an inevitable squeeze is building. Definitely something to mull over as you watch this space.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.